All right, so welcome to the deep dive. You guys picked this one out, and we're really excited to dive into it. Today, it's all about technical patterns in the stock market and how news can kind of supercharge them. We've got some really cool research from some really smart people over at the University of Zurich to unpack here.
Sounds fun.
Yeah, imagine if you could spot a market crash just by looking at a chart and reading some headlines. It's almost, kind of sci-fi.
Hmm.
But stick with us here because what we're going to find out is that this is might be closer to reality than you think.
Yeah, it's a fascinating area for sure, where like human behavior and market trends collide.
Yeah.
We always think of the market, as this like rational machine, this efficient thing.
Hmm.
But let's be real. I mean, emotions play a huge role in all this stuff.
Yeah, totally. It's like they say, the market can stay irrational longer than you can stay solvent, right?
Yeah.
Okay, so before we get into all the details of the research, maybe we should talk about like the elephant in the room, right? The
Mhm.
efficient market hypothesis, which basically says all info is already priced into a stock. So like looking for patterns is a waste of time.
Right.
So if that's true, like why is technical analysis, the whole charts and patterns thing still so popular?
That's the million-dollar question, right?
Yeah.
I mean, and that's where behavioral finance comes in, the efficient market hypothesis, or EMH. It makes sense in a world of perfectly rational people, but we're anything but,
Right.
right? Emotions, biases, the whole herd mentality thing. I mean, all of those influence how we buy and sell stocks, which in turn create patterns, these little traces of,
Yeah.
our collective psychology.
So basically, our human imperfections are creating opportunities for those who can, like, see the matrix, see those patterns.
You got it. And that's precisely what these researchers from the University of Zurich are looking at. They weren't just asking, can AI predict stock prices? They focus specifically on, those classic patterns that traders have been using for decades. So they're taking
They're
these.
taking this old wisdom, and throwing AI at it. That's really cool.
Exactly.
But how do they even teach a computer to, like, see these patterns?
Yeah, well, they use something called convolutional neural networks, or CNNs for short, and these things are amazing at image recognition. Think about it like teaching a computer to recognize different breeds of dogs, right? You show it 1,000 pictures, and it learns all the subtle features that distinguish a golden retriever from a poodle. Now, instead of dog photos, imagine doing that with stock charts.
Wait, so the AI is literally looking at the shapes of the charts, like those head and shoulders patterns I've heard about?
Exactly, the study focused on 8 classic patterns: double tops and bottoms, head and shoulders and its inverse, broadening tops and bottoms, and triangle tops and bottoms. They literally resemble those shapes on a chart.
Okay, so that's starting to make sense. They feed tons of historical stock data to the AI, and it learns to pick out these patterns like a pro.
Hmm.
But they didn't stop there, right? There was another layer to this whole thing, something about news sentiment.
Absolutely right. They wanted to see if the news amplified those signals from the patterns. They analyzed massive databases of news from Refinitiv and Tonglian and categorized it all as positive or negative. So imagine this.
Okay.
The AI spots a head and shoulders pattern hinting at a downturn, and then bam, some bad news about the company drops.
Okay.
Powerful combo.
I see where you're going with this. It's not just about the charts themselves. It's about how those patterns interact with, like, the emotional waves of news in the market.
You nailed it. That's the real innovation here, right?
Right.
So to answer your earlier question about whether AI can predict the market, the answer is, well, it's complicated. But this research is saying that it can get pretty darn good at spotting those moments where the scales are tipped.
Okay, now I'm really hooked. What did they find was this AI-powered crystal ball able to predict the market's every move.
Well, not every, I mean, markets are complex, right?
Yeah.
But the results were pretty remarkable. First off, the AI was incredibly good at spotting those patterns in both the U.S. and Chinese markets, and often even before traditional methods could. But here's the kicker. When they combine those patterns with news sentiment, especially negative news, the predictions became even stronger.
That makes sense. Bad news hits, fear takes over, you get panic selling, and that creates like this ripple effect through the market.
Exactly, and that's what the research showed. Those emotional ripples, combined with those pre-existing patterns, created a much clearer signal for the AI to pick up on.
This is really fascinating stuff, but let's get down to like the brass tacks here. What does all of this mean for the average investor? Can I use this info to make smarter decisions?
Here's the takeaway. While technical analysis isn't some magical crystal ball, remember, markets are always changing. It can be a powerful tool especially when you factor in the news and how people are reacting to it. Understanding these patterns and how they interact with news sentiment can give you an edge. But there's a catch.
Oh, a catch. Don't leave me hanging.
Well, the study also found that these patterns work better for some companies than others. For example, in the US, stocks with high momentum, those with prices already on a strong upward or downward trend, tend to be more predictable.
So if a hot stock that's been skyrocketing suddenly forms a double top and some bad news comes out, that's a way bigger red flag than the same pattern on a stock that's been just, cruising along.
Exactly. The study also found that companies with a lot of institutional ownership, think big investment funds, were also more likely to react predictably to those patterns. These big players have more clout, so their buying and selling can really move the needle.
So even in our data-driven world, it's still all about human psychology, huh?
Precisely. And that's what makes this research so exciting.
Yeah.
It's showing us that even seemingly irrational market movements might have predictable patterns, especially when you layer in the emotional impact of news.
Yeah, I'm already feeling like I have a whole new perspective on the market. But I have a feeling we've only scratched the surface here, am I right?
You're absolutely right. This research focused on very specific patterns and news sources, but what if we could go even deeper, right? Imagine analyzing even more subtle emotional signals, like social media trends, to predict those market swings before they even happen.
Whoa, that's next level stuff. We've only just begun to explore the amazing insights from this research. And for everyone listening, we've included visuals of these patterns along with links to dive deeper. Definitely worth checking out. Now, we haven't talked about how these patterns play out differently in the US and Chinese markets. Let's get into that next. Okay, so we were just talking about how certain companies in the US are more sensitive to these patterns and news sentiment. Did the research find similar things in the Chinese market?
That's a great question. And the answer is not exactly. Remember how momentum was a big factor in the U.S.? Well, in China, company size seemed to play a much bigger role.
Interesting. So you're saying smaller companies in China, maybe the ones that aren't as established yet, might be more vulnerable to these emotional swings triggered by patterns and news?
That's the idea. The researchers discovered that technical trading rules worked much better for those smaller, higher momentum companies in China. It's like their stock prices are more volatile, more easily swayed by, changes in sentiment.
Makes you wonder about the role of those big institutional investors in each market, right? We talked about how companies with lots of institutional ownership in the US tended to react more predictably to those patterns. Was that true in China too?
It was, but with a fascinating twist. Institutional ownership did make those patterns more reliable in both markets. But get this, in China, the researchers found a bit of a contradiction.
A contradiction. Now I'm really intrigued. Tell me more.
Okay, so they found that the companies with high institutional ownership in China were also the ones where technical trading strategies had made the most profit in the past. But here's the catch. Those excess profits tended to vanish the following year.
So it's like those institutions were catching on to the patterns, exploiting them for a while, but then the advantage faded as others caught wise. Almost like a game of cat and mouse.
Exactly. It suggests that the Chinese market might be a bit more efficient, in quickly adapting to these signals.
Mm.
Remember the efficient market hypothesis we talked about earlier? It argues that any predictable pattern will eventually disappear as people exploit it.
Right. So this research is painting this really dynamic picture of these two markets, showing how even factors that seem similar can play out differently depending on where you are in the world.
Absolutely. And it underscores the importance of not using a one-size-fits-all approach to technical analysis, right?
Yeah.
You have to consider the specific market, the kinds of companies you're looking at, and even who the big players are.
Okay, so let's get down to what everyone really wants to know. Did this approach actually make money? The researchers built an actual portfolio based on those patterns and sentiment signals. How did it do?
Well, in the U.S. market, their portfolio steadily grew over the long term. If you held this portfolio from 2003 to 2021, the cumulative return was seriously impressive, and the annualized Sharpe ratio was 1.38.
Hold up. For our listeners who might not be familiar with the Sharpe ratio, it's basically a way to measure how much return you're getting for the risk you're taking, right? So a higher Sharpe ratio means you're getting more bang for your buck. Like imagine two investments. One gives you a high return, but it's super risky, like betting on a horse race. The other gives you a slightly lower return, but it's much safer, like putting your money in a savings account. The Sharpe ratio helps you figure out which one is the better deal overall.
Exactly. And get this, the performance in the Chinese market was even more impressive. From 2014 to 2022, their portfolio achieved an annualized Sharpe ratio of 4.04.
Wow, that's a huge difference. So not only did these patterns work in both markets, but they were actually more effective in the Chinese market.
That's right. It suggests that even though those institutional investors in China might be catching on to these signals, there's still a significant edge to be gained by combining technical analysis with news sentiment.
Okay, so this portfolio is clearly outperforming the market. But is it just riding on the coattails of other factor, like that momentum factor we talked about? Did they account for that?
They did. They ran their portfolio through some rigorous tests using models that account for things like momentum, market size, and value.
And did our pattern sentiment portfolio pass the test?
It did, with flying colors. In both the U.S. and Chinese markets, the portfolio generated a significant positive alpha.
For those who aren't fluent in finance speak, alpha basically means the extra return you're getting above and beyond what those standard risk factors would predict. So this means the pattern sentiment combo is adding something unique, right? It's not just riding the wave of something else.
Exactly. It's not just about momentum or company size or any single factor.
Hmm.
This combined approach is capturing something more subtle, about market psychology and how it reacts to both visual patterns and news events.
This is absolutely mind-blowing. It's like we're learning that AI can be trained to, like, see the market like a human trader, but with the added power of crunching massive amounts of data and factoring in news sentiment. This could be revolutionary.
Right. It really could. And think about the potential applications beyond investing. What if we could use this kind of analysis to understand consumer behavior, anticipate shifts in public opinion, even forecast geopolitical events?
Wow, the possibilities are endless. It really makes you wonder what other hidden patterns are out there just waiting to be discovered.
Exactly. That's what I find so exciting about this whole field.
Mhm.
We're just scratching the surface of understanding how human psychology and collective behavior leave these traceable marks on complex systems, whether it's the stock market or even society as a whole.
It's like we're cracking the code of human behavior. We've covered a lot of ground already. But before we wrap up this deep dive, let's talk a little about the future. What could all of this mean as AI keeps getting more powerful and we collect even more data? So we've been talking about how AI can spot these patterns in the market, even factoring in new sentiment. It's already pretty mind-blowing, but where could this all go next? What happens as AI gets even smarter and we have even more data to feed it?
Well, I think we're just at the tip of the iceberg here. Imagine being able to detect those subtle shifts in sentiment, those early warning signs of a market bubble or a political upheaval, all thanks to AI that can read the emotional landscape better than any human expert ever could.
That's both exciting and a little bit scary, isn't it? This power to predict or maybe even shape the future. Like if everyone starts using these AI tools, will it just become a self-fulfilling prophecy?
It's a valid question. As these technologies become more powerful, we have to be mindful of how they're used, right?
Mm.
But I think, like any tool, AI can be a force for good or bad, depending on the intentions behind it.
Right, I hear you on that. Knowledge is power, but it comes with responsibility. So for all the listeners out there who are thinking, okay, this is all very cool, but what does it mean for me? What's the one thing you'd want them to take away from all this?
I'd say the biggest takeaway is this. Even in our data-driven world, human psychology still matters. A lot. Whether you're an investor trying to read the market or just navigating your everyday life, understanding how emotions and biases influence decisions can give you a real edge. And who knows, maybe one day, with the help of AI, we'll be able to decode those human emotions even better, leading to more informed decisions, less risk, and maybe even a more stable and prosperous world overall.
That is well said. I don't know about you, but I'm feeling incredibly inspired right now. Like we're on the verge of something truly transformative.
I agree. It's an exciting time to be alive, that's for sure.
Well, that wraps up this deep dive into technical patterns, new sentiment, and the future of AI. We've only scratched the surface of this fascinating research, but for everyone listening, we'll include links and more resources in the show notes so you can explore further.
Yeah, and remember, the best way to navigate this ever-changing landscape is to stay curious, keep learning, and never stop questioning. Who knows what amazing discoveries are just around the corner, right?
That's it for this episode of The Deep Dive. Until next time, stay curious.